Welcome back to another episode of Singapore's Real Estate Explained, brought to you by the JNA Investments team. And today, instead of a new launch series, we have another new host called Jerralyn,
Christian O,
who's not here anymore. So you will see her in Locked series, and you can explain a little bit more, why are you on our investment series?
Yeah, so we're actually starting this new series called the Asset Progression Series, where we share with our clients or you guys on case studies that we have done with past clients, and we actually review back on their case to see if, let's say, they did actually take the action, what would have happened. So we want to share this a little bit more transparently with you guys so that you guys don't make the same mistakes.
Yep, so we'll share with you everything from the start, when they found us, why were they holding on to this particular property, and what made them think of offloading, and if they were to offload, what were the options that they had back then, and which option did they eventually go for, and how were the results after that?
Yes.
Okay, let's start with the first one.
Okay, so a little bit of a background of this client. She actually found us through one of our referrals. And at that time, she was holding on to this one-bedroom CCR property in Orchard. And at that time, we were wondering, why did she buy this property in Orchard? Initially, when she reached out to us saying that she wants to offload this property, and she shared with us the size of this property, which is about 818 square feet.
Sounds pretty big, right?
Sounds big. I thought it was
it's one bedder.
If she didn't tell us it was a one-bedder, I thought it would have been a two-bedder. It's the size of a two-bedders now, or maybe even a 2+ study.
No, actually now 3-bedders are less than 800 square feet.
Now some 3-bedders could be around 800 square feet.
Yeah.
So this was a one-bedroom, 818 square feet in CCR, freehold project near to the MRT. What could have went wrong at that time when she first bought this property? So then when she met with us, we actually helped her to analyze to see, okay, if she were to hold on to this property, what were some options in terms of capital appreciation, and whether or not it makes sense for her to sell and move on to a bigger property that can give her better appreciation.
Yep.
All right. So now let's take a look at this property over here. It's actually this project called Cainthill Crest.
Atas address in
Cainthill. Okay. So at that time, when she first bought this property, we actually asked her, why did she buy that property at that time?
Yep.
So she said that she thought it was a good deal. We'll share with you later on why. And for her specifically, it was because it was a freehold in District 9 in Orchard, and walking distance to MRT as well as 313 Somerset Mall.
I mean, it kind of fits the criteria that an investor will look, or a buyer will look at, right? And if let's say you want to rent, it doesn't seem like it could go wrong.
Yeah.
Unit next to the MRT, right in the heart of Orchard, you'll get pretty good rental on it. And later we'll break down for you how much rental can actually cover in terms of your mortgage.
Yes. So as an investor, a lot of people always think, or maybe if you're watching right now, as an investor, what are you actually looking out for your investment home? So this particular client, she wanted location. And it's something that a lot of investors look out for. Like location, as long as it's in a good location, like what can go wrong? So okay, District 9, 248 units, decent sized unit, mid-sized project. So over here, location-wise, we can see that it's actually walking distance through the back of Emerald Hill, that it's actually walking distance to Somerset. So location-wise, it's actually really convenient. So let's take a look at how much she bought this property at that time. So turning back to 2020, she first bought this property in 2020 during COVID at $1.55 million. And if we take a look, the highest peak for Cainthill Crest one bedroom in 2019 was about $1.8 million. So looking back, 1.55, not too bad. I actually got a discount like 1.55 million versus 1.8 million, which is at the peak. It seems like I got a 150k discount.
Yeah.
But what she didn't know was the quantum for this was a little too high for one bedroom. Because at that time when we met her, we were looking at, okay, let's take a look at some of the surrounding options at this price point on what buyers could actually get. So before she met with us, okay, disclaimer, she didn't buy this property through us, okay? And another thing was she actually has been listing this unit on the market for almost a year before she actually met with us. So when she met with us and she shared her problems and we actually analyzed into the property, we kind of understood why it's been on the market for so long. So let's take a look at why. So if we take a look at the past prices for this unit size, it has been averaging at about 1.72 to 1.76 million.
So usually the prices, looking at the graph, it's been pretty stagnant since all the way from 2010s, in fact.
Yes. So thankfully, she didn't hold this since 2010. She bought this in 2020 at probably one of the lowest price point
Yeah,
of
when there was a little
Cainthill
bit of a
Crest.
dip over
where
there.
there
That's
was
when
a
she
slight
entered,
dip.
right? Yeah.
Yes. So at that time, I was checking with her what's the asking price that she was listing it at. I remember she was asking about 1.85 million. And so far for the past 1 year, there hasn't been any offer for the unit. So after looking into the property analysis for her, we took a look into what was average price point of a freehold 1-bedroom in District 9 and District 10.
Actually, when you took over the unit, did she kind of give a feedback on why the for 1 year there hasn't been any offer?
She didn't really understood why, because there wasn't any analysis or shares with her that was done with her past agents. So what she was doing was just basically waiting for an offer to come in, but she didn't know what was the issue with this unit and she didn't know why it wasn't moving. So when we actually analyzed the property for her, we actually looked into, okay, let's take a look at what's the average price around the area for a 1-bedroom and what options buyers could actually have at about 1.8 million if let's say that was her asking price at that time. So let's take a look at the average prices for District 9 and 10 freehold 1-bedroom. If we take a look over here, we have the price chart comparing the orange line. Orange line over here is Cainthill Crest 1-bedroom. On average, you can see in terms of the price point, it is way higher than the average blue line over here, average District 9 and 10 1-bedroom freehold, which is hovering around the price point of about 1.2 million. And in this case, this unit is at about 1.8 million, which is 600K higher than the average price of the freehold 1-bedders in the area.
So potentially, it also means that they may be able to get, let's say, a 1+ study or 2-bedder.
Yes.
Maybe nearby.
Yes. So when we saw this chart, we thought, okay, we have to see what are some of the surrounding options available for buyers at the price point of 1.8. Because then we already kind of know that, actually this price point, you can kind of get a 2-bed, 2-bath.
Yeah.
Or even like a 2-bed, 1-bath. As compared to someone, I mean, on a practical standpoint, you would probably want to get like a bigger unit or like a more number of bedrooms if you can, compared to 1-bedroom.
Yeah.
So a lot of people always see, okay, if I am trying to sell my house, what I would refer to is the bank valuation. Unit valuation or bank valuation. You can have it from SRX, you can have it from your banks. But at 1.97 million, is this really something that buyers would want to pay for this 1-bedroom freehold unit in Cainthill?
I think sometimes how the per square feet comes about, especially when it's a smaller development, is that they take the surrounding transactions per square feet, as if let's say that development itself has not enough transactions, right? And then they use it and multiply it by the size. Yeah.
Yes.
So I think for property-wise, there are two ways to look at it. One is from the per square feet, one is from the quantum point of view.
Yep.
I think in the past, a lot of people look at per square feet meaning, let's try to find what's the biggest per square feet gap. But then they forgot the importance of like quantum and total price. Let's say you're looking for a property, what's the first thing that you look for?
Price, like how much can I even afford?
The quantum and the budget, and then you filter from there. So even if let's say the per square feet is very low, if the size is very big and the quantum is very high, if the budget doesn't allow us, it's something that the buyer just cannot consider.
Yes. So very good point on that, right? If we take a look at the per square feet of this unit over here, actually if we take a look at the per square feet of this unit size, at that time, 1.55 million, she actually entered at 1895 PSF. And it may seem like, hey, actually 1895 PSF for Orchard, it sounds like a very good deal for freehold. But I think something that she really forgot to factor in is the quantum for this unit size. Yeah, so 1.55 million, then this is where we think, okay, actually if we turn back time, at that time, 1.55 million, what could I actually have bought at that time?
A lot of things.
And first, of course, let's take a look at how much you can even fetch in this current market. So yes, unit valuation may be at 1.97 million, but 1.97 million, if we take a look at surrounding options, you can see that we have options like Leiden Green, a 2-bed 1-bath that's also a freehold, and it's brand new. It's going at about 1.79 to 1.8 million dollars. And if we take a look at RV residences in River Valley, it's also located in District 9. 1.75 million. In terms of layout over here, in terms of size, it may seem like it's smaller at 678 square feet, but the layout is efficient enough that it can fit a 2-bed 2-bath comfortably.
Yep.
And the good thing is over here, there's also no balcony space. So this 678 square feet is actually almost a fully livable space. And then let's take a look at, okay, if let's say I'm looking at a 1-bedroom around the area, how much is a 1-bedroom there? So 1-bedroom option nearby Cainthill, there's actually Killiney 118 at 1.5 million for a 1 bed, 1 bath for 624 square feet.
So meaning at close to 1.8 or even at the valuation of 1.97, comparing to competitors, it's almost like 500K above whatever other people are selling. Means you have to justify like why would your unit as a one bedder be able to, yes, slightly bigger, but be able to sell, let's say, 400K above.
Yes. And in fact, a lot of the initially when we were actually marketing this place, the main concern that we had from the buyers was it's at a price point where I can get a 2-bedroom, or these people where they were looking at a 1-bedroom, their budget was around the price point of about 1.6 to 1.65 million. So these were some of the challenges that we got on the ground when we were marketing this home, which we kind of expected because we have already done the analysis. We knew what buyers were looking out for. And whenever we do the analysis, we want to see, okay, next time when I'm actually selling, what options do buyers have? So then this is where we want to come in with really objectivity on the numbers and the data.
I think you're in a stuck position where you are like at a 2-bedder pricing, but then you're not a 2-bedder. So 2-bedder buyers would likely not consider yours. And you are bigger than a 1-bedder. So it means your quantum is
Way
much higher.
bigger.
So the 1-bedder buyer also cannot consider yours. So you're like, you will really have to find a very niche kind of group that says, okay, you know what, I just want like a huge 1-bedder.
Yes. Yeah. It's really from a purely own stay perspective. And this buyer over here, she is a single lady. And I mean, eventually the buyer that bought this unit, she is a single lady and she's just looking for a space for her and her 2 dogs. So the space kind of matches what she wants because then she was looking for somewhere where there's a huge living area for her dog to be running around in the unit, which a lot of the other 1-bedrooms cannot offer. So again, like what Grace mentioned, it's a very niche kind of buyer who can really appreciate this space, but at the same time, they are also kind of concerned because then they also still need to spend on renovation. So on top of this price point, they still need to factor in at least about $50,000 to renovate the space. Yeah, so then this is where we want to weigh out the options for our client. So based on our analysis, this was where we kind of see there is a cap on the growth of this unit compared to her selling and then restructuring this asset into an asset that can appreciate way faster than this unit over here. So what we did for her was to also review her rental yield. So at that time, she bought this to rent it out. And a lot of investors out there, it's very common where they buy properties thinking, hey, can I rent out this property?
You want to be a landlord.
You want to be a landlord.
I mean, online, it sounds great, right? I mean, there's a lot of stories of being landlord. And you're using the rental to just cover your mortgage. And all you have to do is just service the initial down payment and you just let the tenant pay for your mortgage, which sounds like a perfect plan.
Yeah. But I think a lot of people forget, what is my exit strategy? So over here, if we take a look at non-owner occupier property tax now, it's way higher than in the past.
Yeah.
So for those of you who are not familiar with what this actually is, so in property tax, there's actually 2 types of property tax. We have owner-occupier property tax, where you are paying this when you actually stay in the unit, and there's another property tax which is a non-owner occupier property tax, where you have to pay a slightly higher tax rate for those of you who's renting out your property.
Actually, not slightly.
Much higher. Much higher. Actually, it's actually at least about 2 to 3 times.
3 times, yeah.
Yeah, so it's actually 2 to 3 times.
And
so
the government is saying that, you know, if you're going to profit or earn from this, right, they want a cut of it also.
Yes. So for her unit size, her property tax a year is actually about $5,000 to $6,000 a year. So over here, let's take a look at the breakdown of her rental calculation. So her rental income at that time, she was getting about $4,500 a month.
Like, not too bad.
Not too bad. It seems like I'm getting 4.5K pocket money every month. But sometimes people always forget to factor in the expenses that goes behind holding on to these properties. And this is where you see a lot of red.
Explain to me these red numbers, please.
So over here you can see, okay, let's look at the monthly, annual, and her holding period, which was about 4 years. So monthly, she's getting about 4.5K in terms of her rental income. Annually, it's about $54,000. And on a 4 years holding period, actually it seems not too bad, $216,000. But this is where the major expenses comes in terms of holding on to this property. Mortgage interest, every month you're looking at about $1,800. Annually, you're looking at about $21,000. And for a 4 years holding period, you're looking at about $87,000. Maintenance fee. Maintenance fee for this unit isn't cheap. It's about $583 for a 1-bedroom. Annually, you're looking at about $6,900.
Because it's in the CCR region. Normally, CCR as MCSC is very expensive.
CCR usually is higher, definitely because of the facilities and everything that's offered in the condo.
Yep.
And then annually, for maintenance fee, you're looking at about almost $7,000. 4 years, you're looking at about almost $28,000. Your property tax, every month you're looking at about $456. So about $5,400 annually, and total for 4 years holding period, you're looking at about almost $22,000. Rental income tax. So rental income tax is actually on top of your income tax. So your net rental income on top of your income tax, this is how much they charge you. So in this case, she was quite a high income earner, at least about $20,000 a month. So in terms of the tax bracket for the additional rental that she's getting, she's at least being taxed about 15 to 20%.
Yep. So I think there's a difference in Singapore where I think in other countries they have like capital appreciation tax, meaning when you sell and you earn the capital,
Capital
right?
gains tax.
Yeah, you have the capital gains tax. The good thing about Singapore is, for now, not yet, the government is not charging any capital
Hopefully
gains
not.
tax. Yes.
Yep.
But they do charge it on the rental side.
Yes. So rental, it actually falls under your income tax filing. So over here, annually, she's paying about $2,000 on a conservative side, very conservatively $2,000. So 4 years, she's looking at about $8,000. Rental agent fee, so annually about $2,400, so 9.8K for 4 years. And so if you're looking at your total expenses per month, you're looking at about 3.2K a month. So now let's take a look at the net rent. So 4,500 for your rental income
Minus all
minus
the
your
rates.
total expenses, all the rates, you're looking at about 3,200 in your net your expenses. So your net rent is only $1,260.
So suddenly it doesn't look as sexy as 4,500.
Yes. Now if we multiply it by your annual expense, you're looking at only a net rent of $15,000, and for a 4 years holding period, your net rent is $60,000. So actually, if you calculate this, $60,000 is not much because you still have to pay for your stamp duty.
Yeah.
You still have to pay for your agent fees. You still have to pay for all these other expenses. So now if we take a look at the capital appreciation, she eventually sold this unit at $1.7 million. So at that time, she was thinking whether or not she should let it go at 1.7 because she was initially expecting 1.8 million. But then this is the question is, when can I get that 1.8 million? So then we actually track back and we'll show you later on how much the units were selling at after that.
Yeah. And I think she's a bit fortunate because if you were to look back at the chart, right, this was a property that for many, many years, it didn't appreciate.
Was stagnant.
Yeah. So she was in a good situation where COVID, a lot of the resale actually went up because of a lack in the supply, because new developments couldn't be built, right? And a lot of the resales actually jumped. But if she was in a different time period, factoring the expenses, there is a chance that she may have made a loss on this property.
Yes, despite the rental yield, she may still have made a loss because there are still expenses like your stamp duty that you also have to pay for. So eventually, she first bought it at 1.55, sold it at 1.7, which was a 150K gain. Rental income of 216K minus your holding period expenses, minusing your agent fee, minusing your stamp duty, the total expense over here is actually $239,000. So if you can see over here, just looking at your rental income itself, it doesn't even cover the total expenses.
So if it stagnates,
If it
technically
stagnates,
you made a loss
You're
on this
like
property.
minus 20K.
Yeah, maybe put a fixed fee better.
Yeah, so actually you put in your bank and don't touch it is actually better. So over here, if we take a look, actually is capital gain more important or is rental income more important?
Yeah.
So based on this calculation over here, it's a lot clearer that, hey, expenses for holding on to a resale property is very high because you have to pay for your maintenance fee, your property tax, your mortgage interest. So all this together, her net return was actually about $126,000. Then you may say, hey, actually it's not too bad because she didn't lose money.
Yep.
So then we want to see, okay, if let's say we take a look at her situation at that time, we bring her back to 2020.
If
and
she
we
didn't
see-
buy Cainthill,
If she didn't buy
what would
Cainthill
she have
Crest,
bought?
what could she have bought? So it's always about opportunity cost, right? And what better options are there out there for her at that time?
Yeah.
So then this was where we actually guided her because sometimes clients, they really don't know what options they have. And to some clients, they may think, maybe I should just hold on to this property to the point where it reaches to the price point that I'm looking at. But then the question is always whether or not the chances of it reaching that price point is possible. Yeah.
I think in her situation, she actually did profited. So it was a little bit easier. But we've also met clients that, hey,
After
they bought
10
into the property.
years.
Yes, after 10 years, it's either it's a loss or it's a break even.
Yes.
And there is always this emotional tag to it that, I really don't want to let go of it because I'm making a loss. Even though knowing that, likely the potential is not there because it's been so many years and there is no factor that's going to push it up.
Yes.
That's why we come in to try to explain, hey, it's not always about gaining from this first one, but what's the opportunity cost that you're missing out?
Yes. So we wanted to show her the opportunity cost of holding on to this property. If let's say she doesn't take this offer and move on to another asset that can give her a better appreciation. So what we did for her was to actually guide her through data, which she also mentioned it was really what gave her the confidence to really move on from this home. So over here, we can see based on unit size performance by region, we actually took the data for 1-bedroom freehold and 2-bedroom freehold in District 9 and 10 versus if let's say she had put her money in OCR, 3-bedder or 4-bedder. And I had some clients asking, actually, why are you guys comparing to 3 or 4-bedder in OCR versus a District 9 property, which is in CCR? So the reason for that is because we want to look at the quantum. So earlier we were talking about quantum. Yes, PSF may seem like it's important, but quantum is as equally important. So then we wanted to compare based on a similar quantum. If let's say I can buy a District 9 1 or 2-bedder, I can most likely buy an OCR 3 or 4-bedder. So this is where we wanted to give her a clear comparison on opportunity cost if let's say she were to hold on to this property. And if we take a look at this chart over here, we can see that for District 9 1-bedroom, it's obviously not performing as well as OCR 3 and 4-bedders. Yeah, so then just this chart alone gave her a much higher confidence that, okay, it's really time to let go of this property because the past 1 year, she hasn't been getting any offer. We took over, within 3 months, we managed to get an offer for her where the buyer initially wanted to offer 1.6. We managed to push it up to 1.7 million. And we showed her that, okay, if we take a look at opportunity cost, let's say back then in 2020, if she had bought a different project. So over here, we had our clients. At that time, we had some clients investing into Treasure at Tampines.
Yep.
And there are also other projects out there that performed way better. But let's take a look at Treasure at Tampines because this was one of our clients' case studies as well.
The quantum was very similar. We said at 1.5 plus million
1.5.
instead of the Cainthill 1-bedder, you could enter into a 4-bedder at Treasures.
So Treasure at Tampines at that time, you can see over here in July, it's about in 2020 as well. At that same period, for 4-bedder, for 1238 square feet, you can get it about 1.5 to 1.6 million.
Yep.
And if we take a look at the selling price, the 4-bedroom last year was selling about 2.1 to 2.15 million. So the gain over there is about 400 to 500K for the 4-bedder. So then we want to see, okay, let's take a look at the actual net return of these two properties. So over here, we can see that Cainthill Crest, for her unit, the capital gain was about plus $150,000, rental income $216,000, and then expenses was $239,000. And then Treasure at Tampines at that time, people may think, but I'm not getting rental. Should I still buy into this property? Because some people, for them, they feel like they have the mindset that
moving in immediately and having rental income is the best because for new ones, I have to pay the mortgage, but I don't have rental to kind of cover. So that's the mindset that, sometimes you just got to shift.
Yes. So over here, if we take a look at expenses, yes, to some extent, you don't get rental for Treasure at Tampines. But the plus point over here is actually the capital gain.
Yeah.
Because if you see the two comparisons here, Cainthill Crest was plus $150,000, but Treasure at Tampines was plus $450,000. So that's a huge difference of $350,000 already. And then rental income, because this client over here, their SSD hasn't passed yet.
I think they actually bought post-launch. Yes. So a lot of people also have the mindset that, hey, it's something I already launched, I already missed out the first opportunity.
Yep.
It's not something that I should consider. And then they just keep waiting and balloting for brand new launches.
Yes. But in this case, our client bought post-launch. So upon TOP, they haven't passed their SSD yet and they had to rent out their unit for about a year, which they managed to get about $60,000 in rental income. However, the huge difference here, in addition, aside from the capital gain, is actually the expenses. So you can see over here, expenses for Cainthill Crest is about $239,000, which obviously your rental income doesn't cover. But if we take a look at the expenses for Treasure at Tampines, it's only $97,000 for this past 3 years.
And so it's more than half.
Yes, it's more than half for Cainthill Crest in terms of the expenses.
Yeah.
And the reason for that, one of the huge part in terms of the expenses was because of the mortgage interest, your mortgage interest, as well as your property tax. So these two combined together plays a huge part in the expenses for holding on to a resale property. And if we take a look at the net return, Cainthill Crest made about $126,000, which earlier we were saying, actually, if you take a look at the net return, it doesn't seem like it's too bad. It's okay. You're not losing. It's fine. But actually, what other options she had at that time was, if let's say she had invested into Treasure at Tampines, she would have earned $417,000 instead, which is a huge difference of about $300,000.
This also could mean that, your next opportunity, let's say her next purchase, it would mean that she would have another 300K in terms of equity to maybe go for a
almost a $1 million up in terms of budget.
Yes, correct.
Yes.
Assuming her loan is able, she's able to get the loan.
Yes. Considering that she can actually leverage from the bank. So this is the two differences and what we mean by opportunity cost in the market. So then we actually look back at the past
now to
transactions.
The question, did she sell at a good price?
Yes. Down to the question. So let's say we take a look at that time. If she had rejected that offer and she waited again in the market, the two other following units that sold were sold only 6 months later in December 2024. This unit was sold in June 2024. So if she had rejected that offer, she would have to wait for another 6 months to actually get an offer for this unit, and it would have been at a price point lower than 1.7 million.
Yep.
So you can see the two units that were sold after were sold at 1.65 and 1.66, which is about $50,000 lower, and 6 months later. And okay, the only unit that was sold at the price point that she was looking at was in March 2025 at $1.8 million, and that is almost a year after her unit is sold. And then the question is, if she had waited for 1 year to actually get that 1.8 million, she would have missed out on the opportunity for her buy side.
Yeah. So now we'll talk a little bit on her buy side, right? Exactly what were the options, and when we actually pitched to her or share with her what the opportunities are. Again, there are two options, right? One is she could go back into the resale with good rental yield, which we've experienced through Cainthill. Second one is to jump into a new development with good capital appreciation. Then we had to share with her, without the rental income, why would the capital appreciation be much more important?
Yes.
So we had the option to say, okay, if we were to look at, let's say with the quantum of about 2.4, she could go into a RCR next to MRT, which is what sometimes people have a struggle with, right? If I go for something brand new, I may have to go slightly further out. But with that same budget, if I were to get something older, I can get something next to the MRT, better characteristics of the development.
Yep.
So with 2.4%, with 23 years loan tenure for her, the mortgage of a 2.4 million property in the resale market would have been about 8,564. So one thing she was concerned about was the cash flow every month, because we would have to assume that we don't get rental every month. There would be some vacancies, and every time there is a vacancy, it means that she has to have that cash flow to tide her through. So if mortgage at about 8,500, her MCST about 350, property tax about 350, your total cash flow is about 9,264, which she was not as comfortable if, let's say in a month she didn't have rental, this was the amount that she would have to cough out to service this mortgage. Assuming, let's say she does get a rental about 5,500, the outflow would then be about 3,764, because then you take 9,200 minus 5,500, her total outflow is about 3,700. Of course, then every month she has about the max CPF that comes in, which is about 1,500, meaning her outflow in cash is about 2,200. So then it makes it something more palatable. If there is a rental of 5,500, at least her cash flow rather than 9,000 plus is just about 2,200. So this was the first option that she had. Then, of course, we then broke down the cost. So like what Jerralyn mentioned just now, we can't just look at the rental covering the mortgage. We need to look at what is the cost, which is basically the amount that's going to be thrown into the sea. Out of the 8,500, when we break down interest and principal, interest here is about 3,600. So we don't count the principal, because when you sell the property, you basically get it back in terms of equity.
Yep.
So 3,600 plus your MCST plus your property tax. How we calculated renovation, we did it on a very prudent approach. I think 15,000 are good enough to not do a lot of things, because Jerralyn, you just renovated your house.
Renovation is not cheap. So 15,000 is really the bare minimum.
Every time you think that you want to set a budget, usually you would exceed the budget, because there's so many other things that would come up after that. So 15,000, how we calculate it on a monthly basis is, back then the SSD was 36 months, right, which is 3 years. We divide it by 36 months, which is 417 a month. Agent's fee will be about 229. So the total cost is about 4,976. Meaning if your rental doesn't cover this 4,976, technically you're bleeding every month. So a lot of times people kind of overlook the cost that would pile up over time, and they assume that every month I do get rental.
Yes.
So let's say they do get a rent of 5,500, then yes, it covers fully the cost, and the tenant will be paying the principal of about $524 per month.
Yes.
So
but
rather
the question
than
is whether or not it will make Capital
sense.
gains.
Yes, correct. So if it doesn't make capital gains, let's say it stagnates again,
Yes.
over 3 years of 36 months, you would earn a grand total of 18,864.
Which doesn't cover your buyer's stamp duty.
It doesn't cover your agent fees also,
Yes.
probably.
Yes.
So you'll be making a loss on this property if you just purely based on rental. So then, we shared with her, it was to go on a new development. I think it's her first time. So there was a little bit of difference in terms of the payment or the cash flow because for BUC, it's progressive. Meaning, in other countries, sometimes you will see like abandoned buildings because developers are being paid and halfway through the building phase, they just run away. So I think Singapore government, to protect people, they say that, okay, you need to build up to a certain level before I kind of disperse the payments to you. So that's why it's being in progressive. So there are a lot of numbers on this on here, but what you just need to see is the monthly installment plus the monthly cash top up. So when she buys a BUC property, we shared with her that, before the foundation is actually called, which is in 6 months' time, there'll be no mortgage payments, meaning no interest. And for BUC projects, you don't pay property tax, you don't pay
Maintenance fees.
Maintenance fee, yeah, because nothing is built yet, right? So you don't pay anything. When the foundation is called, that's when you start paying $561. So she was like, actually 561 seems very much more manageable than 9,000.
Maybe it's her monthly Grab fare.
Yeah, correct. So $561, that's her monthly installment, which then she don't even have to come up with cash because every month she comes in, her CPF comes in about $1,005.
Yep.
So technically, she still has a surplus of about $990 that gets accumulated over time. Now, of course, when the stages go on, you go on to framework, you go on to wall stage, that's when you'll see that the monthly installment starts to increase from 560 to 1,006 to 2,002 to 2,008. Out of which you will still continue to pay with your CPF because you would have already built a good amount of CPF.
Yep.
And you have zero cash top up all the way up to, let's say, your car park stage.
Yes.
And at that time, you will likely be very close to when you're going to collect your keys already. So when she saw this, she felt like it matches her cap. I mean, it was a much more comfortable cash flow for her because she knew that, okay, she just need to set aside maybe, let's say, 40, 50,000.
Yep.
And it would serve her mortgage for the next 3 years. She don't have to worry
Worst
about
case
it.
scenario, she just need to set about 40, 50K.
Yeah.
And because of how low the monthly installment is, because of the building phases, and it's based on the foundation stage to the TOP, this is where she felt like, hey, it's more comfortable. I just need to set at $50,000. Even if there's no rent that I'm not getting, it's comfortable because I already set this amount and I know that it's not going to exceed that for the next 3 to 4 years.
Correct.
Yeah.
So then the next time she will have to think is when she hits TOP, which is when from an investment point of view, that's when the property, you've waited long enough for the property to be built. That's when people are willing to pay premium for it because then there is the TOP effect that comes. So when it hits TOP, that's when she can either consider to sell or rent it. In fact, at TOP, when you collect your keys, you don't even pay the full mortgage.
Yes.
Because again, Singapore government is very fair. They say, I don't want a developer to do a bad job and just run after that. There is a 1 year defects check, meaning anything wrong, the developer has to settle. And once buyers are satisfied, then that's when they get the full payment. That's when CSC comes in, which is a year after the TOP.
Yes. And because of this defects check, if anything happens to the property, she doesn't have to fork out additional cash upfront to
No
fix
renovation.
And no renovation.
Very
needed.
minimal.
Yes, very minimal because the developer will take care of the defects if there is.
Yep.
Yes. And the good thing is, even when you rent out your property, you may even get additional cash flow because the thing is, for this 1 year, you're not paying for the full mortgage yet.
Yeah. 15%
Yeah.
is not dispersed.
So even if the SSD isn't passed yet, she can still rent out for a year to wait until the SSD passes before she sells it.
Yes. So the next one we then looked at is we talked about resale costing, which is all your MCST and property tax. In BUC costing, the only cost that you're paying out is basically your interest every month because you can't rent it, right? So there's no agent fee. You don't pay for property or maintenance. So you would see that, at the front, the interest rate, or rather the interest being paid is really very low. Out of, let's say, $560, your monthly interest is about $238.
Yes.
If you remember going back to the resale, your interest every month is $3,006. So this is more than 10 times lesser in terms of the monthly interest you're paying. Of course, gradually it increases, but it will still be lower all the way till you collect your keys. That's why from an investment point of view, if you don't want to deal with the hassle, the BUC project gives you a much better or a healthier cash flow. You don't have to buffer as much. But of course, we then have to say, okay, out of all the BUC projects, how then do we select something with good capital appreciation?
Yes. So I think based on the breakdown over here, we can see the clear difference between the expenses that we are looking at for BUC versus a resale. So not saying that you shouldn't buy a resale, but if let's say you're buying it for investment, this is where we should really look into the costings to break it down to see which one is a more objective purchase for your needs.
So I think back then, right, when during COVID, when the interest was very high, it really didn't make a lot of sense going to the resale market. But of course, now with the interest rates kind of dropping, then you have to re-look at the costing, to redo the numbers to see, hey, does it make sense or not? If let's say, this place has potential growth in the future and my costing is low because interest rate is low, then maybe there is an opportunity in the market. Okay. So after she sold her property, there was a window that came up where a 4-bedder at Lentor, they were starting at about 2.2 plus, I remember, 2.2 plus, 2.3 plus. Yeah. And we thought that it was a very good opportunity for a renter because when we were looking at the OCR 4-bedder, the average pricing that it has hit was about 2.8. So there was a huge gap between the total price. So that was something that we looked at, when she was selling her property previously, she bought way over the quantum. Now we're trying to help her buy way below the average quantum.
She got herself a good deal.
Yeah. So we went to look, Panorama 4-bedder, there were 0 units available. The last transacted was about 2.62 million. So I knew that, okay, for a resale property, if someone is willing to pay 2.62, if I can enter at, let's say, 2.3 to 2.4 or even 2.5 for a brand new project that's also next to the MRT, it's a very, very safe entry. All you have to do is, worst case, exit at whatever your resale property is.
Your neighbor sold it.
Yeah.
And something that's already 10 years older.
Yes.
You're getting it for a brand new project at a much lower price, where surrounding resale 10 years older, you transacted way higher.
Yeah. So the next thing we did was we pulled out the entire Lentor 4-bedder prices. You would then see the quantum ranges from about 2.7 all the way up to even 3.2 million averagely in each of this development. So we saw 4-bedder at Lentor Central for like 2.38, 2.4. We knew it was a no-brainer deal for her to enter into it was like a 3-bedder in other areas already.
Yes.
Yeah.
So the price point, it's the complete opposite of her investment for Cainthill Crest.
Yes.
Instead of going way above the average of the 1-bedders, we went way below the average of the 4-bedders in OCR and in Lentor.
Yeah. So it may not have fit all her criteria from an ownership perspective because, you're not going to get Orchard, you're not going to get like a mature estate. But from an investment point of view, she later on saw that, she actually got in way under a lot of what the neighbors have been transacting, as well as what the secondary market and the resale has been transacting also.
Yes. So then we usually go back into looking at our past clients' case studies to see, okay, if let's say at that time she hadn't sold her unit, and if let's say she continued to hold on, what would have changed for her? So if we take a look at her unit for Cainthill Crest, if she didn't sell, she would have to hold for at least another 6 months for an offer to come in, and it would have been lower. Or if she wanted a price at the price point she was looking at, it would have been another 1 year later, almost 1 year later, but she would not have been able to enter into this 4-bedder at Lentor at about 2.35 million.
Yeah. So I think it's always about the opportunity cost that you're missing on the market, not so much from trying to milk the highest out of your current unit. So if you're in the market or you're thinking of restructuring your portfolio, you're not sure whether you should move or not, there are cases where we say, hey, there is an opportunity. I think there is like transformation in this area and the prices could move. That's when we say, okay, maybe you can still hold up for like a year or 6 months until that transformation kind of happen. But if let's say, we know that there is no other transformation that's going to happen and your prices are going to be stagnating, then we can relook at the market to see, hey, if I exit, what are the other opportunities I can actually enter?
Yeah. And for those of you who's renting out your property, I think it's important to look at your rental yield, your costings, your expenses. Don't just look at your gross rent, because we have met so many owners and they only look at their gross rent until we actually do the calculation for them and they're like shooketh that they're not getting like the actual net rent that they're looking at. So I think the reason why we are doing this series is so that we can actually speak to more owners like you guys who's looking to restructure your asset, so that we can be here for you guys to look into your portfolio and help you restructure if let's say you're looking into that idea.
Yep. So if you're actually looking to restructure or you just want to know what are the options, you can just scan a QR code over here and have someone reach out to you and discuss. So with that, we'll see you the next time. This is Grace.
This is Jerralyn.
Bye-bye.
Bye.